Diana Mousina, Deputy Chief Economist at the AMP. Diana, many thanks for your time today. I just want to go to the RBA and the reason why it's changed month to month so quickly. Is there an issue in this messaging here, do you think?
I don't think there's really an issue. The messaging has been quite consistent. They were always telling us that they could lift rates further in the period ahead, but that April pause was really a result of wanting to see more evidence in the data. And in their mind, they got that sign from the inflation figures that inflation is still running way too high. We were of the view that the inflation data was moving in line with expectations. Actually, it was below their own forecasts, but clearly it's not low enough. So that is ultimately why they decided to increase the cash rate today. I also think that they're getting a little bit more concerned about the potential for a wage breakout from the public sector, and potentially also some of the impacts from high population growth due to high migration and the impacts that has to the rental market.
Well, I mentioned a little earlier about the services sector inflation. And while they note that goods price inflation might be petrol or it might be groceries, whatever it might be, meat prices have come down. We know that. But the problem is as soon as it's in the services sector, it's much harder to get out of the economy. That's what they'd be worried about.
Well, that's true. Services inflation does tend to be sticky. However, in saying that, services prices should follow the trend that we're seeing in goods inflation. And we're seeing that goods prices are starting to come down. I think that as we get through this year, we'll actually see some deflation in parts of the goods sector, and that's already started. So services prices will slow. And the major driver really of services is wages. Australia hasn't had a wages breakout. We've got wages running at 3.5% on an annual basis, or just thereabouts. Compare that to the US, where wages are running at 6%, or the UK, where they're over 5%. The problem, I guess, for the RBA is that they're concerned there could be a wages breakout because the rate of inflation is so high. But I think that that's a bit presumptuous, and that today's rate hike was unnecessary.
OK, I've got a chart up on the screen at the moment that's showing basically the cash rates around the developed world compared with inflation. And so you've got Australia now 3.85% compared with headline inflation at 7%. America's the interesting one because they're going to raise rates, it's expected this week, to above 5%, and its inflation rate is 5%. And the UK, the cash rate 4.25%, the inflation rate 10.1%. It seems as though the cash rate here had got a little disconnected with the inflation rate. They had to try and get them closer together.
Well, looking at it like that, it does look like that. However, don't forget that there is a massive lagged impact from monetary policy changes and the increases that we've had in the cash rate. And Australia is unique to those other countries on that chart because we have a much more sensitive household sector to mortgage rates. If you live in the US or the UK, you could fix your home for a long period of time. In the US, you could fix your home for 30 years. In the UK, they have fixed rates of 5 years and above that as well. Whereas in Australia, the majority of households are either on variable rates or on short-term fixed rates for 1 or 2 years. And we know that a huge chunk of those, about 900,000 mortgages, will roll off those fixed rates this year. So I think that the Reserve Bank isn't giving itself enough time to see some of those lagged impacts from rate rises. And when that impact hits households, it will hit like a ton of bricks.
So tonight, the Governor of the Reserve Bank, Philip Lowe, we can see him on the screen here, will actually be giving an address in Perth. Now, I'm kind of fascinated as to the questioning that he will receive about this surprise rate rise today. But the second thing I'll be interested in is to whether in the spirit of the new RBA review, whether it'll be, interested in telling us a little bit about the debate that went on around the boardroom table and whether all of those directors were on the page to raise the rates today.
I don't know if we'll get that level of detail. I mean, we don't really see how the other board members think or what scale of the dovish or hawkish spectrum they're on. I guess that we'll see more of that when we see the implementation from the RBA review next year. But clearly, I think today's decision was the probability of a rate rise today was always much higher than where the market was pricing it. If last month's decision was a line ball call and they decided to hold, I think that today's was also very similar to that. And looking ahead, I mean, clearly the RBA still has that hawkish bias to raise. I think that that's appropriate because inflation is still high. And if the RBA does water down its rhetoric and it starts to show that it's becoming a little bit more dovish, we could see inflation expectations actually shoot up again, and they want to avoid that. So I understand why they have that hawkish stance, but we don't think that the RBA will be hiking rates again.
Deanna Mousina from the AMP, good to have you on this very important day and a surprise rate decision from the Reserve Bank. Many thanks.